And welcome. It's Mary Ellen McGonagle here with your weekly MEM Edge show, the show where we bring you where the action is in the broader markets. And we certainly have a fair amount to cover this week, a little bit of movement taking place beneath the surface. We'll take a look what you need to be on the lookout for. Going into next week, there are three major areas that I would urge you to certainly be on top of. So first up, let's take a look at that data. We did get housing data last week, and it began the week on a weak note. Existing home sales came in at a 14-year low, and that did pull that group down. However, today we did see new home sales jump to their highest level since May. Now, net, there was an overarching item that affected this group, and that is interest rates. We're going to take a look at those interest rates and those yields. They are creeping higher, and I'll share with you why. Next up, we did get weekly jobless claims, and they came in at exceedingly low levels. This is more indication that the economy is strong. And of course, we want a strong economy. However, that is bringing out that fear that the Federal Reserve will pull back on their rate cut program. So hence we are seeing those interest rates climb. Also, we did see manufacturing sectors continuing to slump. We also got some not great earnings reports from several major industrial companies. So we are seeing that industrial cyclical area pull back. We'll get into that. And then also consumer sentiment. It hit a 6-month high. And all of that was about consumers being confident that Trump may win the election, which is viewed constructively. So we'll see how that lands, of course. And there were quite a few developments last week, all about earnings. I'm going to share with you some of those major companies that came out with strong earnings. This is all about what to look forward to going forward. We've had a strong week, a big week, over 400 companies, but it picks up a whole lot more next week. So we'll get into that. Also, that volatility index is starting to get higher. We're over that 20 level, all about the upcoming election. We are marching down to that finish line on November 5th. So we'll look at the impact the markets have had in the past, looking forward as well. And next week, we get quite a bit of employment data. We are going to get on Wednesday private employment data for October, on Friday overall employment data. And then also we are going to get the first round of estimates for Q3 GDP, and data this week points to a strong number. Again, that would not be great for interest rates if we do see that Q3 GDP come in a little bit higher than anticipated. And even important is going to be some key inflation data. The Federal Reserve's most watched item is going to be PCE data. That's that personal consumption expenditures number, and that's going to come out on Thursday. But I will tell you, the employment data is going to have even more impact. So lots to be on the lookout for next week. Let's go ahead and take a look at those markets and see where did we close for the week. And here we are with the daily price chart of the S&P 500. And I talked a lot about that volatility, interest rates on the rise, and certainly a lot of data and key earnings coming up next week. So the markets did pull back a bit here to that 21-day simple moving average. We still have a positive RSI and MACD. The uptrend is still in place. Now, from here, I am going to share a chart that goes back to 2016, and it is a view of the S&P 500 going into that election that year. And take a look at the tumble. We were down almost 3% on that last week of October going into the beginning of November before that election. Now, I did not show 2020. We saw even more price action there because in addition to the upcoming election, COVID numbers were reaching new record highs. So I didn't feel it was quite as exemplary, but you can go back to any period going into those elections, and oftentimes you will see the market, that indecisiveness as far as where and what may occur does tend to weigh on the markets. Here's another view going back to that 2016 period. And what I'm sharing with you is that volatility index. This is that fear index, or better known as VIX. And again, that last week in October into the election, we did see that volatility spike up to about 23. So be aware of that as we get closer to that election period. We are entering that last week in October. Next up, I do want to share with you another chart from showing historical precedent. This is Meta, and we're looking at a chart going back in time when the company was Facebook. It was within the second year of their just coming public. And we're looking at this late July period when the stock gapped up amidst strong earnings that were above estimates. So a couple of things happened here that I would like to point out. That is, take a look at this super high volume that we got on that gap up, indicating institutions were now believers in the company. In addition to their earnings, the company also had increased their subscribership by quite a bit. Big metric for the company. And this gap up on heavy volume pushed the stock out of an 8-month base. From there, we can see that Meta, and at that time Facebook, did go on, and it went up quite a bit into the beginning of 2014. So this is July of 2013, and the stock doubled over the course of the next 7 months. Now, does that always happen? No, but it is indicative of what often happens when these stocks gap up on strong earnings and they exhibit continued growth prospects. So earnings as the key driver of those big movements. We're going to talk more about that today. It's a lot of what my work is all about. As many of you may know, I worked with Bill O'Neill over many years, talking about what is this mover of these stocks that go on to far outpace the markets, and it is going to be earnings, that number one driver. So let's go ahead from here. Take a look at these companies that are due to report next week. Pretty heavy duty economic calendar. We do have on Tuesday, Alphabet, Wednesday, Microsoft and Meta Platforms, and then on Thursday, Apple and Amazon. We'll also take a look at some of these charts going into earnings and compare that to Tesla, which had an excellent week last week, up 22% after coming in above estimates. So let's go ahead and take a look at some of the movement last week beneath the surface of the S&P 500. This is a view of the 11 sectors in the S&P, a 2-month daily price chart view. I've gone ahead and sorted it. Actually, I will do so right now. On that RSI, that's the indicator that I'm adding. And then I'm going to ask for a descending order on those sectors. And we can see relative strength up here on this upper left quartile and relative weaker areas down on this lower right. What we can see immediately is growth areas more recently are beginning to eke up to this forefront. That would be consumer discretionary, communication services, and technology, slightly outperforming the S&P 500. And then moving through on that weaker side, healthcare stocks are continuing to struggle. I'll share with you one area that is certainly showing weakness within healthcare too, in particular. And one of them has everything to do with this uptick in interest rates. And also taking a look at these weaker areas, you'll see that some of these staples names are dropping below this key 50-day simple moving average with negative RSI and MACD, despite strong earnings from a couple of well-known companies in that area. I did touch on industrials pulling back last week. We are not in terrible trouble, but it is certainly something that you will want to note. If you do see weakness in some of your names, you'll want to make sure they're not in those groups and areas that are also exhibiting weakness. So from here, I'm going to take us down a little bit further and take a look at these ETFs that are really quite powerful for me as far as pointing toward rotation. Where is that strength beneath those sectors? It's interesting to know which sectors are moving to that forefront. First up here is the yield on that 10-year treasury. So you can see that we are up at 4.23. And overall, over over the past 3 weeks, we've seen a general increase in the yield on that 10-year. So the yield on these longer term maturities has everything to do with investors' sentiment about the Federal Reserve's potential interest rate reduction program. So ideally, we would not want to see these rates get a lot higher from here. Next week certainly will help provide some platform as far as what to be on the lookout for with the employment data and inflation data that's due next week. Also up here at the forefront, IGV, and this is software. The software group hit a new all-time high back here at the beginning of October, and it is pulling back. We can see that we saw a bit of movement up here. I'm going to talk more about this in my MEM Edge twice weekly report. On Sunday, we have a couple of software stocks on that list that are faring better than that group, but you'll also want to know why it is pulling back. Also up here at that forefront, I did talk about volatility, and we closed above that 20 level. Anything above 18 is generally considered a nervous market. I'm certainly anticipating that we may see it rise a bit more, again, going into those earnings reports and then also the election. Moving through KRE, the banking group, this particular group did get hit today due to troubles with the New York bank. And we can see really it has been quite volatile. We've had these many fits and starts where the group attempts to fare well, hit a new high, and then pull back. We did see a number of these bigger banking related names pull back in tandem. This is Goldman Sachs. We can look at any number of names, but just note too that they are in an overbought position, particularly Morgan Stanley, after that big run up. Next up, looking at the sub-industry groupings, let's go ahead and take a look. I talked about healthcare pulling back, and this is one area that did fare really well last week, but is pulling back this week. And it's IHI. This is the medical devices ETF. And it's an area that has a number of larger companies in there, and they are not putting out good numbers. We're going to take a look at a couple of those stocks, in addition to stocks that have gapped up, because you'll want to know how to handle that if names in your portfolio are gapping up or down in response to earnings. Also taking a look here at IWM, and this is the Russell 2000 index. It is one area that will suffer if interest rates continue to increase. A lot of these smaller companies have a lot of debt they're looking to potentially put through at a lower interest rate, and they do tend to carry more debt than these larger companies, so they're going to be very impacted. Also, a pullback in bank stocks will hit IWM, that Russell 2000 index, as well. Another area that does not fare well in rising rates, biotech, also during uncertain periods. And you can see that biotechs are continuing to pull back here. This is another area that requires quite a bit of capitalization in order for these companies to grow. Also, I did mention higher interest rates and housing, and it did hit home builders quite a bit. Let's take a look at this group chart, XHB, the S&P 500 home builders group. We are now back below this key 50-day simple moving average. A couple of characteristics that you will want to be aware of, and that is this fairly heavy selling on volume as this group has been descending lower. We now have a negative RSI and a negative MACD. So certainly on the near-term side, housing stocks struggling as investors really try to put up with this rising interest rate environment, but also mixed reports from home builders. Now, from here, let's go ahead and take a look at what is shaping up and has been in the markets. And what I'm sharing with you now is that initial interface page on Stockcharts.com. And it's a very simple, but I believe powerful exercise during earnings season. And that is from the moment the market opens, if you're that actively involved, really at the end of the day works as well. But you want to take a look at, for instance, here, the S&P 500 and your biggest market movers on any given day. And what we're on the lookout here for is what is driving that price action, and are we seeing sector and group movement in tandem? And that will really inform you as far as money flows and what is keeping people interested in these markets. So from here, let's go ahead and pull up a candle glance, 2-month daily price chart view of today's biggest movers as an example. And we can see Tapestry up here at the forefront, Deckers, a shoe company. Both of these are consumer discretionary related, a REIT stock, and so on as we move through these biggest movers. And I will tell you the key driver, and it has been consistent all last week, are those companies that have reported earnings that are above estimates. They have really hit this top performing group list throughout the week. So as we move through, I will take a look with you at some of the companies earlier in the week and see how they progressed throughout the week after experiencing this nice gap up on earnings. In fact, we can do that right now. Let's take a look at Tesla. They did report their numbers after the markets closed on Wednesday. This is a daily price chart. And let's take a look at some of the characteristics. We're looking at a daily price chart here on Tesla. You can see we had that gap up, very heavy volume. And really, we need only go back to this early July period to see an equally strong advance on heavy volume as institutions came in. And then we did have a nice, this move was about 19%. We did have a nice secondary move today in a kind of difficult market. We were up another 3%, also on heavy volume. And we now have that MACD with that black line up through the red, indicating a new uptrend with that RSI in bullish territory as well. We also now have a potential longer-term base breakout on Tesla. It's looking quite constructive, but let's take a look without that at what took shape going into earnings. And first up is the fact that Tesla sold off rather dramatically going into that earnings report. It was no longer sitting up here near this near-term high. That's one factor I would urge you to consider as we go into earnings next week, that the stock did pull back going into that report. And then also the fact that Tesla had a pretty high short interest going into earnings. So in addition to investors interested in the growth and them coming in ahead of estimates, but also short covering as a potential rally cause. But either way, also from here, we're going to take a look at an intraday chart. And again, many of these companies are going to be reporting after the markets close. So oftentimes you'll see this initial gap up on the open the following day. So from here, a couple of things you'll want to take of note, and that is after that initial gap up, take a look at this period beyond. This is a 15-minute price chart of Tesla, and you do want to see that third bar advance above that first bar. And we did see it nominally, but it did take shape, and that oftentimes will signal further near-term upside for that stock. Now, from here, we did see the stock pull back a little bit midday with the broader markets, but let's take a look at some other characteristics. Again, a 15-minute price chart of Tesla, and you will see that the RSI is still up here in positive territory, despite a significant 22% move for the stock. So on that super near term, in addition to on the daily chart, you may see further upside. We'll get into some of those names that have faltered after gapping up so that you can tell the difference as far as whether you should stay with that stock, particularly if you are a near-term investor. Longer-term investors will want to key in on that weekly chart, and you'll see that we are in bullish position on that weekly chart as well. But as always, you will want to stay on top of that particular stock. Let's take a look at another name that gapped up last week, Travelzoo. The company experienced quite a bit of growth over in Europe. And as many of you may know, Europe is a bit ahead of us as far as that growth and reduced inflation prospect. So TZOO on the daily, and we can see this nice gap up, super big volume. Again, that MACD black line up through the red. And then also we already had a positive RSI. Now, certainly by any measure, we are in a bit of an overbought position. But again, let's go ahead and take a look at that intraday and how that just extra step can make a difference. This is TZOO on that 15-minute. And I talked about this concept that after that first advance, you'll want to take a look and stay on top of where this RSI is residing. Now, by most measures, you could have gotten shaken out because the stock closed below this 5 and 13 simple moving average. And we did see that RSI dip into negative territory. However, even though we had that negative crossover on that MACD on this 15-minute, it stayed up here in positive territory. So again, if you're an active trader, your buy zone here is a move back above these moving averages, get that RSI back in positive territory, and you're in fine standing there. And from here, we'll take a look at a gap up that did not take shape as far as moving beyond that. And it is MOH, a health insurance company. And from here, we can see that the stock had really sold off. This group has been struggling due to funding and government policies. And we can see Molina Healthcare did sell off going into earnings. And you would think, well, if they surprised higher, that would be great for the markets because, or for that stock. I pointed that out with Tesla, but there are some key differences here with MOH going into earnings, and that is that their deterioration has pushed down these 10 and 21 and that 50-day simple moving average. So that's a pretty heavy downtrend that is going to need to be reversed. Now, from here, we can see that initial gap up on Thursday, but take a look. The stock closed at the very lower reaches of its trading range on the day, and we also descended further into negative territory with that RSI. We had a secondary close in that lower portion of the trading range, which is negative as well today. So noting the key difference on those stocks that go on to gain more versus those that are unable to. So here we are with yesterday's gap up on their earnings, but we can see here's that move back below these moving averages. We did dip back up, so you could have certainly stayed with it, but now on that 15-minute of MOH, once that RSI gets into negative territory, you will want to pay attention. Again, this is certainly more for shorter term investors, but it is of note as far as giving you information on whether you should play that gap up or is the stock poised to trade higher or not. Also, you will want to pay attention to industry group movement, and I talked about weakness in those health insurance companies. Now, from here, let's take a look at stocks that did not fare well after reporting their earnings. Again, all about how you handle them beyond that. This is Honeywell, HON, and this is a company. I'll point out a couple of characteristics going into their earnings that you will want to take into account if you have names that are due to report next week. So here we are with HON. It's an AI data center global builder, and you can see it experienced some nice strength here for 2 weeks going into their earnings report. The stock did enter an overbought position. So in essence, they're priced for perfection. This is unlike Tesla that sold off and had strong numbers. From here, we can see that this drop initially after that release on heavy volume, indicating distribution. And we have suffered further today, down a little bit more. So from here, we can just go ahead and take a very quick look at that 15-minute and use that similar exercise when looking at stocks that report below estimates. And here we are with that gap down. The stock remains below these moving averages and that MACD very firmly in negative territory. Next up, we'll take a look at one other name that faltered last week after reporting earnings, and that is IBM. And the stock, again, I'm hoping you can note before I even point it out, was priced for perfection. We were sitting up here at a new near-term high, RSI up above 70, And you can also see that the volume on that selling was pretty high. We are now below that key 50-day simple moving average, very decided negative RSI. So this is what can take shape when the stock, again, is priced for perfection, and any little bit of imperfection, the stock oftentimes will be punished. One other group that I did fail to take a close look at when we were doing our ETF view and looking beneath the surface of the broader markets is semiconductor stocks. And this is a really key area at this point in time. We have a couple of names that are in the semiconductor space due to report their earnings next week. I'm using SOXX, the iShares Semiconductor ETF, and you can see how weak the group has been overall. We did manage to close just above this 10-day simple moving average, but not the strongest close for the week. We have that MACD hovering around that net neutral, and also this RSI waffling around net neutral as well. NVIDIA, of course, does trade in its own universe. We'll take a quick look at this because the stock did experience a nice base breakout on Monday, and it's looking quite a bit different. But at some point in time, we may see group pressure come down even to this particular stock. AMD is due to report their earnings next week. They are a little bit AI related, but certainly not to the extent that NVIDIA is. Qualcomm also due to report their earnings. So we will be keeping, certainly from my work, a close eye on that. And that's it for this week. Everyone, have a fantastic weekend. I'll look for you here again next Friday.